Hello and welcome to the Deduction, a Tax Foundation podcast. I'm your host, Kyle Hulehan, and today we are back with another episode, and we are joined by Garett Watson, Director of Policy Analysis at the Tax Foundation. Garett, how are you doing today?
Doing well. How are you, Kyle?
Are you ready to talk about our one big, beautiful bill? I mean,
Ready as ever. We've been spending about a week deep diving into this bill and providing all sorts of analysis. So ready to chat.
Right. So we're going to get right into this. So tell us, what is the one big, beautiful bill, and how does it relate to the expiring 2017 Tax Cuts and Jobs Act?
So the one big beautiful bill is the major congressional effort to deal with, in part, the expiring tax provisions that are coming at the end of the year. So most of the individual tax changes that came from the 2017 tax law, known as the Tax Cuts and Jobs Act, expire all at once in one big cliff. And this has been talked about a lot in tax policy circles. We knew it would motivate Congress to come together and try to introduce one big tax package, because that's typically how these things are done nowadays on the Hill. And this one big beautiful bill is the content, finally seeing the actual legislative content of what this may look like. It was introduced and passed out of the House Ways and Means Committee last week. It's now being stitched together with other spending changes as part of one big beautiful bill that will be considered on the House floor as soon as this week. And the headline aspect of this package is making permanent most of the changes in the 2017 Tax Cuts and Jobs Act for individuals. So we can go into that. There's a lot of other tax changes in here, both for businesses and individuals, tax cuts on top of the package that amount to about $4 trillion in tax cuts over 10 years. So lots to talk about here in terms of existing and new provisions, and outlook moving forward as it gets to the House floor and moves its way, of course, into the Senate.
All right. So what are the key provisions as well as some of the pay-fors? This seems like it could be expensive. And, how does this affect individuals and businesses?
Right. So the big continuity, I think, important thing to emphasize is that permanency for most of the 2017 tax law. So that includes the lower tax rates on ordinary income, the consolidated tax brackets, the doubling of the child tax credit and the standard deduction, the elimination of the personal exemption, the in a variety of what we call base broadeners, basically tax increases in certain places to make up for the other tax cuts. So that includes the restricted limitation for mortgage interest. It includes a bit more generous SALT deduction, which is interesting. That's a big flashpoint of $30,000 for all individuals, with some income limits for upper earning households. In addition to a variety of other new provisions or tweaked provisions. One big one that's come out has been a turbocharged pass-through deduction. That is a special deduction for pass-through businesses and small businesses, going from 20% under current law to 23%, making that permanent. We're looking at, and as we'll get into, some new tax cuts for deductions for tipped income and overtime, a few other items. And that all amounts to about a little over $4 trillion tax cut over 10 years. That was about the target they were aiming for. And what we find when we did our modeling on this is it does have some positive economic effects. So we found a 0.6% increase in long-run GDP. And that does result in some revenue feedback. So on a dynamic basis, when you include the effects of the economy from this bill, it would cost about $3.3 trillion. So about a 19% haircut there on the headline cost. And of course, all of this will come together with other spending changes to see the net figure, which we expect would increase the deficit over 10 years once it hits the House floor.
And yeah, so I'm wondering, what are the main benefits of this bill? Like, who are the notable winners and losers among these income groups?
So on the TCJA stuff, of course, we've been emphasizing that if no action is taken, about 62% of taxpayers would see a tax hike at the end of the year. So they're one big winner in that they're avoiding a tax increase. There would be this big tax cliff that they're avoiding, but that is just a continuation of the status quo. So a lot of folks would see that as just continuing this year's tax design, which is generally true, and they're avoiding a tax increase. For other folks, they are going to see net tax cuts on top of that, most notably for some of these new ideas. So, for example, there is an exemption for tipped income for most employees who are not higher earners. There's going to be a deduction for overtime pay for the premium portion, the 0.5 and a time and a half. If you're a hourly worker, you'll be able to get that deducted from your tax return, whether or not you're an itemizer. There's a special additional deduction for seniors worth up to $4,000 that will provide some benefit in lieu of the president's promise to exempt Social Security from tax. Social Security will still be subject to tax, but you'll get that additional deduction, which might help offset some of those taxes paid on Social Security benefits. And there's also, deduction for auto loan interest, a few other items in there that will add up to an increase in after-tax incomes overall. We find in our distributional analysis that most major income groups across the income spectrum would see an increase in after-tax incomes. There's one caveat. I think further down the line in a few years, there will be tighter rules on certain credits like the child credit, the earned income credit, the Affordable Care Act's premium tax credits that will offset some of these tax cuts at the bottom. We find the bottom 20% by 2034 would see a 0.1% increase in after-tax income. So just over the line. But that is one element that's been emphasized is there are some credit restrictions that may mute some of the positive benefit for those at the bottom. But overall, we're seeing somewhere between a 2% upwards of a 4% increase in after-tax incomes overall, though we do have to factor in the fact that this would increase the deficit and have some effects of its own because of the debt path that we're on.
So, Garrett, I'm wondering, how is this bill projected to impact economic growth and federal revenue over the next decade? Like, what are we seeing as like the headlines for this?
So a couple of headline takeaways from the bill's expected economic impact. One is we do expect the long run size of the economy to be larger at about 0.6%. And that represents, tens of billions of dollars of additional economic output every year, mostly from encouraging more work. So lower marginal tax rates for individuals will encourage them to work more, and that's going to lead to a higher capital stock, a higher amount of output in the U.S. But there's one big caveat on that, and that's primarily because of the deficit impact. We're looking at a $4 trillion tax cut here that'll only be partially offset. That means that the government is going to be issuing more treasury bonds to finance its operations, and a lot of that will be financed from abroad. So a lot of those payments of those treasury bonds will be remitted to foreigners who are financing this deficit. And what that means is a lot of our income we'd otherwise accrue from this bill will end up being paid in the form of those bond payments to foreigners. And that's why we find that while American production is up by 0.6%, American incomes, as measured by GNP, is up only very slightly by a couple hundredths of a percentage point. So it is net positive, but there is that big caveat that the deficit impact is muting the overall benefit to American incomes in our modeling. And of course, there are opportunities as this is still going through the process, right, to turbocharge the economic growth even more. There's several opportunities we can talk about, and that would, of course, raise American incomes further from what we've found so far.
Yeah, and maybe for a non-economist like myself, you could just very quickly dive into this. Why does the deficit really matter? We're talking about the deficit and how much it raises. I think that would be helpful for some people of like, why is this important?
So the overall sort of deficit of the U.S. government is really important because someone's got to finance it, right? And so eventually that deficit needs to be paid for either through tax changes, spending changes to make sure it's on a sustainable path forward. And of course, the folks who are financing it in the interim are folks who are basically loaning the U.S. government money, right? So they expect their principal back and interest. It's that and interest part that we're finding in our modeling that has a negative effect on American incomes. And so we're paying, sometimes it's Americans, right, who are getting that the benefit of that. Sometimes it's folks from abroad, and that of course represents a net outflow of American incomes relative to if we just paid for this right outright. It didn't increase the deficit. We wouldn't have to make those interest payments. It's much like financing something on a credit card, right? You got to pay back the credit card amount plus whatever interest is owed, and that is a loss. Sometimes that there are cases where that's worth it, but it's not always worth it. As anyone with a credit card knows, you can get into an unsustainable situation, and that's sort of where we're bordering on with our debt and deficit situation. I think that's one big headline is this bill, as it's going through the process, risks being a missed opportunity to further address the debt, either through tax changes or through responsible spending changes moving forward. And that's what's actually underlying a lot of the current debates on the Hill about where this bill goes, both on the House floor and in the Senate.
Okay, thank you. That makes a lot of sense. So we're talking about those debates. What are the major political debates surrounding this bill, and including maybe some GOP divisions on stuff like the SALT cap?
Yeah, so there's a couple of flashpoints here. One major outstanding question is on the long-term design of the SALT cap. There is the proposal in the bill, as we mentioned, right, raising that cap from $10,000 this year up to $30,000, putting in some new income limits for very high earners. But there are a group of folks in Congress who want to see that deduction made even more generous to help constituents in their districts who are being hit by the cap. But the big roadblock has been there's been no consensus on what that design may look like. They may want something much more generous. Leadership and folks who are more skeptical of that deduction don't want something as generous. So they got to come up with a design that everyone can live with, that can be put and modified into the bill. That, of course, will cost revenue. Already, this $30,000 cap costs close to $200 billion over 10 years. We're talking about tens or hundreds of billions of dollars more, and that goes back to the deficit math. How do you square these numbers? There's a couple of other things, of course. One is this bill is littered with a lot of temporary policy that a lot of folks would like to see improved. For us, the Tax Foundation, a big one is, of course, the major business provisions where we're providing full and immediate deductions for business investment are included in here, but only temporarily for the next 5 years. And that undercuts a lot of the economic growth. So we'd like to see that permanency. That's one area we can talk a little more about. And of course, the other area is as it relates to spending, what's going to happen to the spending side. That's a big debate right now on the Hill on the future of Medicaid and other programs to make the math line up between folks who are more worried about the deficit and those who are more worried about the impact of those spending changes.
Okay, I got it. Now, what do you think is the legislative outlook of this? How likely is it to pass in its current form?
So it's almost certain that this bill will change, ranging anywhere from minor changes to overwhelming sort of changes, right? The next step, so now it was passed out of the Budget Committee late on Sunday. So that's the committee that stitches together all the different committee bills that have been put together, the different texts into one big bill. And now it will move on to what is known as the Rules Committee, which can amend this text before it hits the House floor for a formal sort of House vote. So that's where we expect. There's already been some minor changes and some other non-tax items already today. We expect that's where maybe some other changes might happen as it relates to SALT or even the green energy credits, most of which are being repealed in this bill. And so we're watching for that. And then, of course, even if it passes the House, the Senate gets its own crack at the apple. So they will be, there's already folks, senators who have big ideas that may differ quite a bit from what the House is looking at. And so that's what we'll be watching next. And of course, the White House may have its own views as well on how to design this moving forward. Once the Senate acts, then the House has to come back, and if anything is different, they have to repass that legislation because, of course, both chambers have to pass identical bills. So there's still a lot of runway left, a lot of work left to do to get this through Congress and get it to the president's desk for signature. The House is hoping to have something passed by Memorial Day, so we'll see if they end up in that where they are in that process. But that's where we're currently standing.
Yeah, we're really in the middle. I don't know if you remember from school. It was obviously a while ago how a bill becomes law. We're right in the middle of this process of everyone's tossing it back and forth to each other. So it's we're in the mess of it right now. Yeah. But so I'm curious, what do you think? What would you like to see changed in this bill as the legislative process moves forward? What would make this, a better bill for the American people and for our country in general?
So I think there's a couple of common sense things that make a lot of sense, sort of even just stepping back from some of the big controversies. One is seeing more permanence in the bill will be really helpful. It's better to do even fewer things and make them permanent than to do more and more things and have them all be temporary. And that's helpful certainly for taxpayers. It's helpful from an economic perspective. My colleague Erica York and I ran some numbers last week, and we found that if they were to, for example, make permanent the full expensing provisions for our research and development, for short-lived assets, in this bill, along with more generous interest deduction, all that is permanent, you would actually double the long-run economic growth effects from 0.6% to 1.6%, so more than doubling that effect. And it would raise American incomes by 0.9%, so a clear increase compared to the more muted effects of the current bill. So I think that's one lesson that can be learned, something we've emphasized a lot. It's hard because there's always a temptation for gimmicks and temporary changes. Another thing is just making sure that simplicity is really prioritized across the bill. There's a lot of complicated, novel ideas ranging from, reworking some of the income limitations for the pass-through deduction, brand new deductions that have never been tested before, just a raft of complicated things that are going to put more work on the IRS and Treasury and stuff that taxpayers are going to have to catch up on. So I think, greater simplicity just across as a principle across the bill would also be helpful. Part of this has to do with they're trying to do a lot all in one package very quickly, and that's not necessarily a recipe for a rational or simple or pro-growth tax code at the end of the day. And so, I think we do have an opportunity now with, the House trying to finish up their work and the Senate taking a fresh look to prioritize those things. There's still sort of room to improve the bill from where it is in ways that are incremental and not too not requiring a complete going back to the drawing board.
Yeah. Now, I'm curious. You mentioned a couple things. What do you see? Is it the simplicity as like the biggest con of this bill, or is it what it adds to the deficit? What do you think is like the biggest issue of the bill?
Yeah, so I think the lack of permanency, which mutes the growth effects, is one big downside. That's obviously been one of the biggest legacies of the Tax Cuts and Jobs Act was sort of the growth effects. That's something that the framers of this bill want, and there's clear steps they can take to do that. And it folds into the permanency and the certainty that we're providing on the individual side. So I think that that's a clear path forward, very low hanging fruit. Trying to keep things as simple as possible is another, I think, big one. And and the third item is this deficit impact. That is we're already seeing markets move a little bit. It's early to say if this will move markets in a longer term way that worsens our fiscal situation, but this is a big opportunity to right the ship, as it were. And that's this bill is not going in that direction. It's just a question of how big it increases the deficit rather than does it increase the deficit. So I think those are the three things that are probably the biggest priorities to improve the bill moving forward.
All right, Garrett. Well, thank you for breaking all of this down for us. This is really a quick, informative, educational kind of episode. I wonder real quick, is there any of the work you're doing you want to plug real quick? Let the people know what you're working on.
Yeah, so our team is currently working on a raft of follow-up blog posts and pieces covering various components of this package. One that's coming out very shortly by our team is looking at the good, the bad, and the ugly of this bill from our principles and perspective, and that'll be out in the next couple of days, and should be a good overview of what's going on and what could be improved.
All right, Garrett, thank you for being on the show today. And before we sign off, I just want to let you guys know if you have any burning questions, look, you can obviously drop a comment on YouTube. You know how to do that. You can email us at podcast@taxfoundation.org. There's always our DMs on Twitter. You can find us there. And thank you for listening.